There are several legal ways to reduce capital gains tax in Canada, including using tax-sheltered accounts, claiming the principal residence exemption, offsetting gains with capital losses, and donating appreciated securities to charity. Use tax-sheltered accounts. Investing in registered accounts can protect your investments from capital gains tax. Tax-free savings account, TFSA. Any capital gains or other investment income earned within a TFSA is completely tax-free, even upon withdrawal. Registered Retirement Savings Plan, RRSP. Contributions to an RRSP are tax-deductible, and capital gains are tax-deferred until you withdraw the funds, typically during retirement when you may be in a lower tax bracket. First Home Savings Account, FHSA. The FHSA combines features of an RRSP and a TFSA. Contributions are tax-deductible like an RRSP, and qualified withdrawals for a first home purchase are tax-free, like a TFSA. Claim the principal residence exemption. You do not have to pay tax on a capital gain from the sale of a property if it was your principal residence for every year you owned it. To qualify for the exemption, you must own the home alone or jointly and have used it as your primary residence. You must also designate the property as your principal residence on your tax return when you sell it. Offset capital gains with capital losses. If you realize a capital loss when selling an investment, you can use that loss to offset any capital gains in the same year, thereby reducing your taxable capital gains. Carry back or forward. If your capital losses are greater than your capital gains, you can carry the net loss back to apply against taxable capital gains in any of the 3 previous years, or carry it forward indefinitely to use against future gains. Tax loss harvesting. This strategy involves purposefully selling an investment that has decreased in value to trigger a capital loss, which can then be used to offset gains. You must be careful to follow the superficial loss rule, which prevents you from repurchasing the same or an identical investment within 30 days. Donate appreciated securities. Instead of donating cash, you can donate publicly traded securities, such as stocks and bonds, to a registered charity. This is a tax-efficient option because you do not have to pay tax on the capital gains from the donated securities, and you will receive a charitable tax receipt for their fair market value. Plan the timing of property sales. Timing the sale of capital property can help reduce your overall tax bill. Spread gains across tax years. You may be able to split the sale of a property over multiple years, such as selling a portion in December and the rest in January, to spread the capital gains over 2 tax years and potentially remain in a lower tax bracket. Sell in a lower income year. If your income fluctuates, you can time the sale of capital property for a year when your other income is lower. This may result in the capital gain being taxed at a lower marginal tax rate. Claim the capital gains deduction. Individuals who sell qualified small business corporation shares or qualified farm or fishing property may be able to claim a lifetime capital gains exemption, LCGE. In 2024, the LCGE limit was increased to $1,025 million for these types of property. Claim a capital gains reserve. If you receive payment for a capital property over several years, you may be able to defer part of the capital gain by claiming a reserve. This allows you to spread the taxable capital gain over up to 5 years, or 10 for certain transfers to children, rather than paying the full tax in the year of sale. Like our contents, hit follow, like, share, and subscribe. Thanks for watching.